All right, and we are live. Well, welcome everyone to the Fintech Nexus weekly news show. Normally, Peter is the esteemed host of the program, but Peter is getting a little rest in this summer, so we wish him well, and he'll be back next week at the regularly scheduled 5 p.m. Eastern. But I am hosting today, Todd Anderson, Chief Content Officer at Fintech Nexus. Joining me is my colleague, John White, who is our news editor. John, say hello.
Hello, it's good to be back. It's been a few weeks,
All
and there's
right,
so
good
much
to
to
have
talk
you.
about. I can't wait.
Yeah, for sure. And Dan Kwan, formerly of Project Catalyst, the CFPB, and now Dan, tell the audience a quick 30 seconds on the current fund that you're working for.
Sure. Thank you,
We're
Todd and
started.
John, for having
Yep.
me back. So Dan Kwang here. Now I'm an investor on the venture side. So now we are writing checks or telling people no. So with co-founder and the GP of early stage fund called Nevco Ventures, we're primarily investing in pre-seed to Series A fintech startups, but we're also opportunistically deploying our capital in a later stage companies as well. Good to be here.
All right. Well, we'll kick off with an article. I think it came out this morning from our friend Ron Shevlin. So this is from the CFPB. The article is Apple accused of potential consumer data misuse with its buy now, pay later or BNPL service. Current director of the CFPB, Rohit Chopra, said that Apple Pay Later, which is what the BNPL service is called, raised a host of issues, including antitrust and data privacy issues. Some of the other issues mentioned in the article: competition, use of customer data, browsing history, geolocation history, and health data. Tim Cook, on the one hand, has said that privacy is a fundamental right. Ron thinks this is less about Apple and it's more about kind of a shot across the bow of some of these not only big tech but companies in the space of BNPL. In his couple of sentences there towards the end of the article, he talked about if they really wanted to go after the biggest player, they would go after PayPal, which is a pretty big behemoth in this space. Dan, obviously, the CFPB well and regulatory issues well. What are your thoughts on what's happened the last couple of days here?
Yeah, I mean, I to some degree, I agree with Ron regarding in terms of this those comments from Chopra, Director Chopra, are not really about BNPL per se. It's really about big techs entering financial services, and that itself, creates a host of other issues, competition, data privacy, and it's obviously it's not nobody's really accusing Apple of misusing anyone's data, but I do think this play that Apple is making here with regard to BNPL, I think it's a pretty significant departure from what Apple has traditionally been doing, and from, frankly, all the other big tech companies, Amazon, Google, have been doing in the past, which is Apple now actually underwriting those loans. So they are literally just renting Goldman Sachs bank charter to get a BIN from MasterCard so that they can get on MasterCard rails to process those payments. But this is really I think it's a very bold move on the Apple, because no other big tech firms have ever done that. So if from the regulator's perspective, naturally they will be suspicious. What are you going to be doing with this data? And frankly, I think Chopra also mentioned that later this year they're going to issue a report on the findings they have, on the inquiries they have made to the BNPL firms, and he will also probably reveal the next steps from the CFPB. So if there's any regulatory or enforcement actions the CFPB is going to take, I think Apple is right in the middle of that. So that's something, if I was Apple, I would be very, very concerned about.
Yeah, I mean, ultimately, the fear of everyone, at least in the regulatory and the congressional landscape, is that big tech has proven to have issues, and this is beyond just Apple. Big tech generally
Yeah.
has done bad things with data and has done, has misused information in the past. And this is kind of like, if you're coming into this space, you guys need to be ready that it's not going to be okay, Apple's in, great, that's good news for consumers. They're going to need to take a look at it closely, and I think that's part of this. John, any thoughts?
I usually agree with Ron in this case. Mostly I do. What bothers me about regulators' statements is generally they're way too big a blanket statement that is typically overstating the threat, and everyone gets kind of lumped in together. And as Ron states, it's just like, if you're going to get into the space, we're going to be watching you closely. That's really the message there. And it obviously hasn't affected Apple. Their earnings are exceeded expectations yet again. So bully for Apple for looking right down the barrel of regulation and saying, yeah, we just made more money.
To me, the ultimate piece of this is, will one of these firms eventually say, hey, I want to become a bank? And none of them have said that they are. They've all had hands off. We don't want to become an actual regulated bank. It brings a ton of scrutiny, and a host of other issues. But they keep on making these incremental steps, and eventually it's going to come to either we want you or require you to become a bank or not. And we're not there yet, but they're still on this path.
Yeah, this is pretty. Again, I when I this was back in May or June when I first saw Apple's announcement of the BNPL product. I was quite shocked by Apple's decision to bring the risk control underwriting in-house versus having Goldman Sachs taking care of that. So this is really a big departure from the traditional practice. And again, thank God this is Apple. Imagine if it was Facebook that's doing this, I'm sure it's not going to be just CAPB, complaining.
Yep.
You'll hear from Maxine Waters and others, from Capitol Hill.
Yeah, I think Facebook is loath to bring any more negative attention upon themselves right now.
I know.
Moving on to our next story. Coinbase shares tumbled 21% after report that it's facing SEC probe. So this is actually different than the insider trading, which was a former employee that's being accused of insider trading. This is whether or not the platform, Coinbase that is offering unregistered securities. The SEC claims that 9 of 25 tokens allegedly traded in the scheme were securities. Stock overall is down 75%. Like a lot of things are down right now. Dan, any thoughts on what's going on at Coinbase here? And my only final comment is, I think at a time when these crypto native or crypto focused companies need to be as careful as possible, it seems some of these firms keep on kind of stepping on themselves a little bit.
Well, this one, honestly, I have lots of sympathy for Coinbase. So my question really to Chairman Gensler is, where were you in 2021 when Coinbase filed for IPO, right? Or they didn't file; it was a direct listing. So so when you review their prospectus, you basically, I mean, not him personally, but obviously the SEC, the agency, give them the green light to go public. Now you're coming back and say, hey, these tokens are probably securities, and then you are really doing something illegal here. Of course, there's no acquisition so far. It's just investigation. So let's not just put a conclusion here yet. But I think it's really a bit unfair for Coinbase and potentially, and obviously Coinbase is not the only one, and other exchanges that are going to deal with the same kind of issues. And at the end of the day, I think Congress really needs to act. Really provide some certainty to what constitutes securities and what not.
Yeah, I certainly agree there. I didn't think about it through that lens, so that's a good point. I mean, ultimately, that soon enough there needs to be a lot of clarity, because otherwise these firms are operating in the dark unfairly, especially when sometimes it's kind of like a wink and a nod, and then they put the hammer down later. But I mean, it seems as if they just keep on kicking the can down the road. There's some movement, and then we'll get to the story later with the stablecoin stuff that was delayed. But John, any thoughts on the Coinbase news?
My biggest question was, why now, as Dan was saying. It's kind of odd that this comes out now as if it's like breaking news that this is what they've been doing for months. So, do we think it's connected to the unconnected situation with the insider trading, or is it what do you
kind of hammer them twice in a couple of weeks?
Yeah,
Yeah, it's
little
always
suspicious.
there's always some PR in there, that's for sure.
My spider sense was tingling when I saw that.
Yeah, speaking of the regulation and crypto, so the House this week delayed, and I think it was this morning they said they will put it off at least until September. The stablecoin bill, after Treasury Secretary Janet Yellen pushed for changes, there's been some watchdog groups that have warned that it might not protect the financial system from risk. I think that's a bit overstated at this stage, at least. Bill is like we said, going to be delayed a few weeks at the very least, if not a few months. And clearly, the stablecoin issues of the last few months have thrown a wrench into the bill overall. Dan, what are your thoughts on what's going on in the House and overall, the stablecoin piece of legislation?
I mean, I think the legislation doesn't really address the problem that the market experienced in the last couple weeks and months as a result of the problem with Terra USD, right? So that was an algorithmic stablecoin, and which obviously has turned out to be more of a Ponzi scheme at the end of the day, and a lot of people lost money. But if you look at the other stablecoins, I'm putting Tether aside for the time being, but look at USDC. These coins are they are backed by high quality, highly liquid assets, and we haven't seen any kind of problems or even signs of problems with these coins. So, and I'm not really downplaying the significance or the importance of this bill. The bill, I think, does a good job in trying to sort of put a official regulatory or legislative framework around stablecoins, and really giving banks the green light to issue the coins if they want to, which they are unable to or unwilling to because of the regulatory reluctance. But at the same time, I am also wondering, so if the bill goes as it's planned, these stablecoin providers that are currently under the supervision of states, now all of a sudden they are going to be under the Federal Reserve. But that doesn't really stop states from exercising their supervisory authority over them. So they could be actually double. It could be double whammy for them, right? So they are both regulated at the state and the federal level. And again, I'm not saying it's good or bad, but I think from service provider's perspective, the cost will definitely go up, and the cost will be absorbed ultimately by users, by consumers.
John, any thoughts?
Yeah, I get the sense that they're increasingly nervous about the precedent they're going to set with whatever is finally tabled. So that was my instinct that, okay, they've seen some turmoil that scared them a bit. Now they want to make sure they've got it somewhat defensible when it's ready.
I'm also worried about... Sure, go ahead, Dan.
Yeah, the other interesting thing I would just want to point out, so if you think about bank deposits, right? So if bank issues a token, so remember, banks are using fractional reserve, so they're not actually putting 100% reserve behind the currency they actually issued to you. I think this is probably part of the criticisms from the watchdog groups, and they want the assets that back the stable coins to be segregated from the rest of the bank, deposits, and so that's going to be 100% in reserve, which is what's required, by the way, if you were licensed by a state, under the state money transmitter license. That's a requirement for you to have. You cannot have a fractional reserve. You have to have 100% reserve. So that I don't know if that's gonna really reduce the incentive for banks to do that, because they cannot really leverage the deposits for lending and other activities that the bank normally conducts.
It doesn't seem like the banks will be ready to jump in if that's the case, and it kind of stalls the market.
Yeah, we'll see. Yeah, and
maybe that's part of the reason behind it. I don't know. It seems they need to have a the other thing I worry about beyond just the issue that you brought up is there's just so much conflation of the various issues with Terra, and then what a liquidity, or at least the stable coins that are backed by real assets and liquid assets versus what happened with Terra and Luna and all that, and some of the other stuff that's happened in the market with Celsius and others. It's conflating a lot of different issues at the same time that aren't necessarily related. If you look at the underlying technology or the underlying innovation here, some of it just goes back to bad decision making by executives or bets that didn't pay off, which companies make.
Yeah.
And you have Congress trying to put pen to paper or come up with rules and guidelines, and then you have all this stuff happening in the background, which kind of everything conflates at the same time. And I think they need to be careful here and not to overdo it, because if they overdo it, it's going to stall the market for quite some time.
There's an obvious lack of finesse with some of the decisions and some of the wording we're hearing from regulators. Kind of ham-fisted approaches.
Keeping with our crypto theme here, Kraken, which is a crypto exchange, is suspected of violating sanctions. So the Treasury Department is investigating whether or not the crypto exchange allowed users in Iran to buy and sell digital tokens. There is an expectation that they'll be fined. The investigation's been going on for the last few years. Previously they have been fined, Kraken that is, for a different issue or similar issue. I forget the exact details around that. Fined about a 1.25 million. The biggest worry in this article and from those in the government that this poses is that crypto can kind of give bad actors in certain states that are on the sanctions list a workaround. And this was brought up back when the Ukrainian Russian war kicked off, that will crypto become this area where Russian oligarchs and Russian billionaires can kind of funnel and hide their money. Turned out that there is some of that going on, but the way crypto and blockchains transact today, it's hard to move large sums of money through some of these networks, especially with the fees involved with certain blockchain protocols. But Kraken has found itself in the eyes of Washington and some in the news as well for some other stuff. But what are your thoughts, Dan, on the sanctions end around that crypto is potentially falling into, and what does that mean potentially down the line?
I honestly do not believe this has anything to do with crypto itself. I think this is really about some probably bold startup that really doesn't take compliance as his top priority, based on some of the comments that the CEO made and to his team, and also they even published a spreadsheet internally that contains user accounts in Iran and Cuba, which later they made it unavailable to their employees. So that itself tells me there needs to be some maturity in the company. But that being said, listen, 2012, 10 years ago, HSBC was fined $1.9 billion for violation of OFAC, and it's the same reason, right? They actually facilitated the transactions for accounts or residents in Iran. And even recently, this was earlier this month, American Express was fined close to $500K for some violations, similar violations that Kraken is potentially, alleged of. So I do not think this is really a crypto issue. It's really about these startups that are in, money transfer business, and they need to just be careful about their compliance.
Yeah, ultimately, I mean, if someone has a big client like we saw with HSBC that you brought up, I mean, they're not going to cut off a big client. They're going to some of them take the risk to service that client. If they get busted, then they have to pay a fine. But clearly, the client was big enough to take the risk in some of these cases. HSBC you mentioned, and I'm sure the Kraken CEO's got a little bit of wildness to him. So
Yeah,
I think it does relate more to that than anything else.
I agree with you. Yeah, it's more of and plus other things that he allegedly said or did about other issues.
So I want to move on to which, if we were having this show about a year ago, it was certainly a fintech darling. Now that has kind of tumbled a bit, and that's Upstart. So their stock down 94% as end of stimulus pulls rug out from fintech lender. That's the article in Forbes, the headline. So this is really, if you read the article, and there is some truth in this is the first time that Upstart's model has been like really put to the test with economic conditions. That goes for a lot of fintech lenders as well, especially with where we're headed in terms of rates and the recession. So rising interest rates, end of the government programs, late payments on Upstart loans originated in 2021 are now approaching 7% versus 3% for loans issued in 2020. Upstart has now tightened their models along with requests from bank partners. They've also been holding a lot more loans on their balance sheet and having trouble in ABS markets and selling those loans. So, as someone who's kind of took off, it's been a rocky few months for Upstart. I think their technology is very, very good. But Dan, what are your thoughts on Upstart's crazy year? I'd say, to say the least.
Yeah, it's a really tough time for Dave and Paul and the rest of the team so far. But I think we are just in a very different market, right? Different environment. I mean, this never happened in the last 20 years, 30 years actually. Yep. So I think any model, there's no experience for anyone to really draw upon, frankly, other than, okay, now we're about to enter recession. We are experiencing a persistent high inflation. Then we just need to tighten our model. So I think especially given the space Upstart operates, right? So they are really more of a new to credit, subprime, near prime space compared to Lending Club. I think their average FICO score, the customer FICO score is 717, which is really solid prime. And so Upstart obviously will be one of the first ones that experience the pain, and I think the pain will probably, I don't know how quickly it will be spread to others. So we'll see in later this month when we hear the Q2 earnings from Lending Club and others. So that's one part. And the other part is obviously the business model. I think Tom Baker has talked about this, since the beginning of the marketplace lending time. So he basically said that this sort of a funding source has never been really stable. It's always good during the good time. When time goes bad, your funding will dry up. So that's what happened to Upstart. When delinquency goes up, they have to reserve more on the balance sheet, which then they get punished for doing so in the public equities market. We'll see how this thing really plays out in the next 8 to 12 months. It's still a very solid business model, I believe. The technology, as you mentioned, is pretty good. I think it just takes time for them to really adjust and adapt.
Yeah, I mean, part of the reasons you saw SoFi and Lending Club buy banks was to come up with a stable source of funding. I mean, they both, I mean, Lending Club dried up, funding sources dried up. And to be honest, I think they've had a remarkable turnaround from where they were a couple of years ago to where they are today. And I think that's, that it also goes back to the single line business. Monoline business model is just it's not sustainable. It's good to start with, but you need to diversify away from that and come up with different products and different things to sell, because not everything's going to be good times forever.
Yep, exactly.
It was definitely a perfect storm situation of multiplying negative factors against them. There was an interesting story on PBS NewsHour last night that spoke about the complexity of all the various things like the war, supply-demand issues, inflationary pressures, all kind of combining in a very unusual way. So I agree that it's probably not as bad as it looks.
I want to go back to a crypto theme here, and that is Barclays, which is obviously one of the biggest banks in the world, investing millions in copper. They are a crypto firm said to be valued at $2 billion. And so really, I think the big thing here is that while crypto markets are getting hit hard, what you're seeing a larger trend is that institutions are, if not doubling down, they're continuing to show interest in the space. And I think overall, that's not only a good thing for crypto, but it's a good thing for consumers, small businesses, because ultimately, when some of this stuff is built and is working, it's going to be more efficient and at a better cost than some of the old technology that still exists in many of the large banks. But it was a good sign to see that Barclays was investing in copper and showing that big banks still have the appetite for it.
Yeah, you're 100% on this one, Todd. So I do think we are in the probably the deep winter of deep crypto winter now, and I don't know how long this winter lasts. Maybe another 12 to 24 months. But I think it's a really good time for if you're a smart investor and if you believe this is the secular trend, which is crypto will be crypto is here to stay. It's not going to go away, no matter what the SEC does, no matter what the CFTC does, no matter what the Capitol Hill does, it's going to be here. And so might as well get on the bandwagon and even for a $1.9 trillion bank like Barclays, spending a few $1 million is really a drop in the bucket. But it's really a good. It's more of a indication that this is a secular trend to stay.
Yep.
The canary was brought back to life.
Yeah.
They did CPR on that canary, the crypto canary.
So we have just a couple of minutes here, but I wanted to highlight a story from one of our writers, Kevin, here at Fintech Nexus about Quadrata. So Quadrata launched a Web3 passport NFT. And so the NFT, and it's Web3 passports on the Ethereum network. NFT allows users to prove their humanity and KYC AML status to help fight cybercrime and fraud. They say it's Sybil resistant, which is a attack vector that's used by fraudsters and can link to a user's decentralized identifier. They plan to add access to Polygon, which is a layer 2, and that will lower fees by the end of the year and move to other chains as well. I think right now they're just launched on the Ethereum mainnet, but this is the type of product that can help traditional financial services get more comfortable with the blockchain and crypto universe, because KYC and AML is huge. And it's a very important piece of the puzzle for traditional financial firms that are moving into the space and for regulators. And so I think products and innovations like this is only what are big moves that can not only help move the market forward, but also help get regulators a bit more comfortable with it.
Yeah, I think this is probably the second time we're talking about them on this show. At least, from my perspective, maybe they appeared other times as well. So if memory serves, they work with TransUnion, right, to bring the off-chain like AML, KYC stuff to on-chain. So I agree with you. This is really they're building a bridge between the traditional financial services and the Web3. And if they're successful, I think their service will be really in high demand. AML KYC is the really first thing you need to do when it comes to financial services. If you cannot pass that check, everything is nothing can be done. So I think if they're successful, I think there's a lot of promise for traditional FIs to adopt getting to Web3.
John,
I'm
any
embarrassed.
final thoughts?
I'm just going to say I'm embarrassed to admit that my financial advisors have been chasing me for 3 months to update my KYC. So if someone was able to make that painless, I'd be all for it. I will invest.
Well, that's going to have to end our show for today. John, thank you very much for joining us. Dan, thank you as always for coming back. And thank you to our viewers. Same time next week. Peter will be back. So tune in, weekly Fintech Nexus news show. Thanks, everyone. Enjoy the rest of your day.
Take care. Bye.